Welcome to Metcalf Money Moment, the podcast. Unlock financial clarity and confidence with expert insights to achieve your goals. Hosted by Jeb Graham, Ethan Hutchison, and Eric Wymore. Each episode offers decades of combined expertise in wealth management, retirement planning, and more. Join us for practical strategies to inspire your financial journey. Now your hosts.
Welcome to Metcalf Money Moment podcast. My name is Jeb Graham here with Eric Wymore and Ethan Hutchison. How we doing, guys?
Doing good.
Yeah, good morning. Doing well.
Good morning is right. We were just talking about how this is early in the morning to be recording stuff like this, but it's a good wake up call, right?
It is.
Because we're talking about some deep stuff here. We're talking about what's that?
Yeah, it's 5 a.m. outside. You can't see, but
That's right.
Done.
Especially to talk about something like this today. We're going to talk about what they call the silent tax bomb. So, and I know I think this is a great time of year to talk about this. We're at the day we're recording here. It's April 22nd. So tax day was just about a week ago. And hopefully most people got their taxes and they weren't surprised by anything, but I would guess that there's a few listeners here, a few of our clients, that maybe got their tax return, or people that are, out there considering becoming a client that might have gotten their tax bill. And it was a little bit higher than what they thought because of a couple of things that maybe they didn't know were going to transpire that did transpire throughout the year last year. And so today, I think what we really want to do is just focus on that, what we call the silent tax bomb, which are things that happen throughout the year that could surprise you come tax time. And I think, the other thing is that most people, I wouldn't say most people, but a lot of people out there think of their financial advisor and all they think about is, hey, what is the return on my portfolio? How did I do on my investments last year? And I think when you have a higher level advisor, the conversation shifts and becomes more about, yes, you want to get good returns, but you also realize that the biggest, expense that you're going to have over your lifetime is actually taxes. And how do you avoid those? And not only that, how do you avoid having some sort of a tax that you don't realize that you're going to have? And to talk about kind of what the embedded challenge is with a lot of clients right now is that over the last few years, we've had strong markets, which is more of a blessing than a curse, but there is a bit of a curse to it as well. And the curse is that people that have trust accounts, non-retirement accounts, they now have these big embedded gains in their accounts, where if we just do a general rebalance, it's going to generate taxable income for them. Not only that, if you own mutual funds in those taxable accounts, there's big capital gains distributions that are coming out that really you don't have a lot of control over. So now people have these highly appreciated positions. And then not only that, they've got deferred tax liabilities that maybe they aren't planning for. So maybe you have an IRA and you didn't realize, or you realized, but you didn't know what the amount was going to be that you were going to need to take, required minimum distributions and that sort of thing. So today, I think more than anything, what we want to do is just talk to you about what are those things that can catch people off guard. And then more importantly, what you can do and how you can plan for it. So Ethan's going to talk about capital gains and portfolio tax drag. And then Eric's going to jump in and talk a little bit about retirement income and tax traps there. And then I'll talk to you a little bit about, what your expectation from your financial advisor should be when it comes to communication between your advisor and your CPA and tax preparer. So let's talk about cap gains first.
Yeah, I'm going to start this out with a pop quiz, and Eric, you're going to be the culprit here, okay? Would you rather have $5 million in a traditional IRA or $3.5 million in a joint account or a TOD?
I'm going to say the TOD or joint account.
Yeah. And we're going to kind of uncover maybe some of the reasons for that. And none of what we're going to talk about today is really, let me take that back a second. So we're going to chop that out. So what we're going to talk today and kind of expand on the question I asked Eric is the difference in income taxes, capital gains, and we'll kind of touch on some of the income taxes and things of that nature down the road. So looking more specifically at capital gains inside of a trust or a TOD or some sort of taxable account that you may have. So you're going to have unrealized gains at any point in time. You're going to have long-term capital gains. You're going to have short-term capital gains. And there's a big distinction between the two and how those are taxed. And there's a lot of factors that play here. If you're a really high income earner, you might have a 20% capital gains tax. If you're kind of in the middle of the road, you might have a 15% capital gains tax, and then it kind of, tailors itself down to, there's some people out there that have 0% capital gains tax. So working with your advisor and kind of planning for those things along the way and figuring out what your income is going to look like later in life so that you can more better, which is a terrible English, but better anticipate what those taxes are going to look like. Everything we talk about, we're not trying to necessarily avoid taxes. We're just trying to control them and understand them. Taxes are a blessing and a curse. If you're paying capital gains taxes, your investments are doing well. It's a good thing. If you're not paying capital gains taxes and you've got a lot of losses on your books, depending on how you look at that and what lens you're looking at those losses through, that can be a good thing, but it can also be a bad thing. So we don't want to put a negative connotation on the word tax, because if you're, like I said, if you're paying taxes, you're probably making money, and that's the ultimate goal of investing. So what kind of capital gains tax are we looking at? So you're going to have federal capital gains taxes, and then there's a lot of states that also have capital gains taxes involved with them as well. So as a general broad example, if you've got a $2 million trust account or a $2 million joint account between you and your spouse, we call that non-retirement monies. You might have over time consistently put money into that account, and your cost basis is sitting at about $1 million. Well, you've got $2 million sitting there, so you got $1 million of capital gains. Depending on how the contributions happen, you probably have a lot of long-term capital gains that are going to be taxed at 15 to 20%. And then you're going to have some short-term capital gains embedded in there where you're looking at ordinary income taxes, which can be anywhere from 22, 24, 35%, depending on what income looks like. So just kind of controlling and realizing and knowing what those taxes look like, I think just gives you guys better guidance as clients on understanding what those tax traps look like down the road. How do we mitigate and kind of control, or what kind of solutions and value do we provide for our clients in this realm? We're looking at tax loss harvesting quite often. What is tax loss harvesting? We probably talked about it on 9 out of the 10 last podcasts we've done, but ultimately the goal with tax loss harvesting is to maneuver and change the portfolio composition around without churning up capital gains taxes. Okay, so if you've got 10 securities in your portfolio, 5 of them have gains, 5 of them have losses, and you call us and you say, I need $200,000 to go buy a boat. Can I get that money out of my TOD? What we're doing on the back end is looking at what can we sell at a gain and offset by a loss to virtually get you at tax neutral distributions out of that account. Doesn't happen perfectly every year. We rely on the market. So if we've got a down year, it's a great time to tax loss harvest. If we've got a really positive year, there could be opportunities, but there might be less opportunities. And so kind of figuring out what that looks like on a year-to-year basis for our clients is something that we're probably doing behind the scenes. Asset location is pretty big, and Eric's going to touch on this a little bit here in a moment, but asset location, and Jeb highlighted it as well. If you've got mutual funds inside of your TOD or taxable money, your non-retirement accounts, you've got uncontrollable cap gains distributions that occur later in the year. If you've got ETFs, everyone classifies ETFs as tax efficient because they don't have those large cap gains. You can really plan on what the portfolio is going to do in November and December and kind of look back and say, hey, do we have any tax loss harvesting opportunities here? So it's not just what you make, it's what you bring home, what you can keep. And we're trying to lessen the burden of taxes. We can't ultimately get away from taxes altogether, just helping our clients understand and kind of forecast out what all that looks like. So
can I add one thing there, Ethan, to the, I think that's a good topic of conversation. When you talk about a non-retirement account, a mutual fund versus an ETF, right? Is that it's kind of twofold, right? Because a lot of times we have clients that transfer in mutual funds to us that already have a big gain, right? So for us to get it from the mutual fund to the ETF, we would need to take a gain in order to do that. So a lot of times we're having to weigh that. And so if we have a client out there that's like, well, hey, I have a non-retirement account and you guys are holding a mutual fund. If that's the case, the reason is because you've held that mutual fund for a long time. And for us to get from one environment to the other, it's going to cost a lot of money to get there. And it's actually better just to stay in that mutual fund. And that's something it's not a one-time, hey, let's just weigh this year. It's one of those things that, we might look for opportunities to make that switch sometime down the road for them.
Yeah. And it could take 5-10 years to completely exit the position. And depending on the client's risk or tax tolerance, if you will, that goes into play too.
Totally. Yep.
Yeah. So, Eric, where we see this really come to life is when people start thinking about income in retirement. So, enlighten us a little bit about retirement income and some of the tax traps that come along.
Yeah, absolutely. I mean, again, most individuals are really going to spend their entire working career squirreling away money on a regular basis into a pre-tax account, maybe a 401k, and then all of a sudden they retire, life's good, they start drawing Social Security, and then they start drawing off their 401k or their, hopefully a traditional IRA by then, and all of a sudden it doesn't become like how much have you saved and how much are you earning, like you said earlier in the opening. It becomes how can you get that money out in a most tax efficient manner, because that's what's going to save the bottom dollar. And so we've got a couple of different strategies I'm going to share with you, some of the formulas that work for our clients, as well as some of those tax traps that are going to come in the future. And anytime we look at this, we kind of look at like your income, your retirement income is, three different legs, right? You've got kind of that first leg is your maybe a pension or Social Security, right? That's the first leg of your income that's coming in there. That's the guaranteed income. And then you have kind of your savings account, whether that be like an IRA, traditional IRA or Roth IRA. There's a couple of different features on getting that money. Serves its purpose, right? You defer your deferred income tax when you're making contributions to your 401k, building up tax-free growth in the future when you contribute to your Roth 401k or Roth IRA. All serve a very, very important purpose in your retirement income in the future. Then you got kind of the third leg that you just talked about, Ethan. That's the non-retirement account, the brokerage account, or the transfer on death account, where you're able to get money possibly early on in retirement, a little bit more flexibility when you take those dollars and controlling those taxes. So you get those three legs in there, and it's all a matter of where you're getting your money from. So, talk to a client, how much do you need in a year to live off of? They tell us an amount. We figure out what's the best strategy, what's the best account to take it from, and helps them keep that tax efficiency that we're striving for. But if you don't do this, here's what happens with a lot of individuals as well is, again, squirreled away money in a pre-tax 401k forever, decide to retire at 65, kick on their Social Security. They also have a pension. Life's great. All their income is meeting their expense needs, and then they turn 73 or 75, depending on what year they start, and they have this thing called a required minimum distribution. Well, the IRS won't allow you forever to keep your money tax deferred in a IRA account or a 401k. They're going to start requiring you to take out minimum distributions, and those can be large. It's based on a life expectancy table, based on the last year's value, and so on. And we've seen them where they could be $50,000 and they can grow to $100,000, $120,000, even $200,000 that you're having to take out of your retirement accounts. So all of a sudden, your tax bill goes from virtually nothing to you're right in the 24% tax bracket. So certainly, there's a lot of strategies that we try to do early on in that retirement life, that you retire at 65 and you got till age 75 before you have to take money out. How do we get money out of that account so those RMDs aren't so large later on in life? That's a big strategy that we run. Another little trap that kind of pops up is that Social Security tax trap. So again, your Social Security income starts off not being taxed, and then but as you make more money, IRA withdrawals, whatever it is, pension, your Social Security then can turn into taxable income. And first notch is 50%, and then it can go up to 85% of your Social Security can become taxable income. Not taxed at 85%, but 85% of it becomes taxable income. So again, that's kind of, when you're trying to figure out, hey, when's the right time to take Social Security? I'm retired. I've got these expenses that I need to meet. What's the best place to take it from? So we're not getting into that next level of taxation with our Social Security income. Another thing that you need to be a little bit aware of is it's Medicare Irmaa tax, IRMAA, Irmaa tax. So Medicare, basically your Medicare premiums, age 65, you're on Medicare. Your premiums are determined by the 2 years prior income. So 63 and 64 are all kind of calculated into what your Medicare premiums will be. So if you hit a certain level of income, your Medicare premiums are going to be a little bit higher. Make a little bit more income, Medicare premiums can become a little bit higher. So, I'm going to speak in general terms on Irmaa. We're just trying to make sure that we try to keep our incomes at certain levels. So all of a sudden we don't go above a certain dollar amount of income and then our Medicare premiums, jump up quite a bit. So it's just something that we take into consideration, when we're looking at how to get clients their money in the most tax efficient manner, right? So a couple of things that you can do at certain ages to help this process along the way. Obviously if you're age, just starting in the workforce, starting with a 401k, age 30, 30 to 45, let's say, or 25 to 45, most likely it would be better for you to contribute to a Roth 401k. Pay the tax now. Defer the money will go into a Roth 401k or a Roth IRA. It'll grow tax free. Then, when you take it out when you're 59 and a half, it's all tax, that you don't pay any more income tax on it. So that's the best thing that you can do. Obviously, as your income grows, you might need to change that up. And so, maybe when you're in your mid 40s and beyond, that's probably making some really good money. Usually, that's when you probably will want to start going over to the pre-tax bucket of money. So your pre-tax 401k. But along the way, you're kind of always constantly putting money in a non-retirement type of account. Again, that provides a lot of flexibility when you're older. Then when you get into age 60, early 60s, we're really trying to, if we can, try to figure out how to lower our income tax so we don't get into that Irmaa tax bill. Then obviously, in the 60, when retirement age, 65 to age 70, or 75 or so, we're really trying to figure out how we can get that money out of that pre-tax bucket of money as quickly as possible. And then when we're into retirement or RMD season, I know, Jeb, you're going to mention this on qualified charitable distributions, but that's something else that we start adding into the strategy. But there's always something to do at a particular age. And so that's just something to have that communication with your advisor. Like, what should I be doing? Where should I be putting away my money? What buckets do I need to be filling up? And that will go a long ways for your future when you're going to need to turn on that retirement income.
Yep. All makes perfect sense. And I'll tell you, I think if we're going to kind of take all this stuff and start to wrap it up into one theme, which I think we kind of intro this way as well. But I think everything we're talking about here is a difference between having an investment advisor solely and a comprehensive wealth manager or a personal CFO or whatever it is that you want to call it, that's kind of quarterbacking and managing a lot of different things. I think a lot of these things that we just talked about can absolutely be avoided when you have an open line of communication between your financial advisor, investment advisor, or I guess personal CFO and your CPA, meaning what you're doing. And this is kind of how we deal with a lot of our clients. We use Holistiplan, which is a really complex tax management software. When we're using Holistiplan, basically during the year, we're encouraging our clients to send us their tax return from the year before. We're running it through Holistiplan. We're trying to identify any potential tax pitfalls, anything that they can do to maybe avoid or lower their tax bill. But not only that, we're looking at, hey, let's look at their non-retirement account. Let's see what are the embedded gains. How much can we sell this year to keep them in the 0% cap gains tax bracket or the 15% cap gains tax bracket? And what is that liability actually going to look like? And I think a big piece of it is we're not 100% trying to avoid paying taxes because that's impossible, but we are trying to mitigate that. And we're definitely trying to avoid the silent tax bomb, meaning, you get to tax day, you get your tax return, and all of a sudden you find out that you owe a lot more money than what you thought that you were going to. So, real world examples, and I think we kind of hit on these, but I'm going to summarize them, is that number one, tax harvesting is a big deal, right? When in our non-retirement account, we want to offset as many gains with losses as possible. You can also use a strategy called direct indexing that we're not going to go to on this podcast. But I think if you, in your next meeting, if you have a question about that with your advisor, talk about that. We want to definitely time those large gains across many years. Coordinating with your CPA on Roth conversions. So that Roth conversions is not a, hey, let's save money on taxes this year strategy. It's a, hey, let's save money over our lifetime strategy, which is just as important, if not more important, than let's save money this year on taxes. But coordinating that and trying to get as many conversions as you can in that as low of a tax bracket as you can is important. And then back to, what we talked a little bit about is using qualified charitable distributions out of your IRA, as well as charitable giving strategies through what are called donor advised funds. So we have a lot of clients that have charitable foundation accounts that can gift money, and they can gift highly appreciated stock and kind of have a double tax savings because they get to write it off and they avoid paying the capital gain. So using some of those more high level strategies, you're not going to get that advice from a strictly an investment advisor, that's only worried about the returns of your portfolio. So that's kind of the differentiation that comes with having a more comprehensive wealth manager and a personal CFO. It's, using e-money, using Holistic doing ongoing tax projections. And that's obviously our goal with all of our clients when we're working with them. So if you are a client and we haven't had the conversation about your future tax liability, which would be surprising because it's something we talk about in most of our meetings, but certainly send your tax return and let's have that conversation. And again, the goal is not to avoid taxes, it's to control when and how you pay them. So this was productive. Any last thoughts, guys? Anything else to add?
Do you guys know why taxes are never invited to parties?
Why is that?
Because they always take too much.
There you go.
That's all I got. We can cut that out.
Pretty good. I think we should, we should have Googled some more of these tax jokes because there's some good ones out there.
Yeah.
So, but no. So productive time. And this is Metcalf Money Moment podcast signing off.
Thanks for tuning in to Metcalf Money Moment, the podcast. We hope today's episode provided valuable insights to help you unlock financial clarity, confidence, and peace of mind. For more expert advice and resources, visit metcalfpartners.com. Until next time, make every money moment count.
Jeb Graham, Ethan Hutchison, and Eric Wymore are registered representatives with and securities offered through LPL Financial, member FINRA SIPC. Investment advice offered through WCG Wealth Advisors, a registered investment advisor. WCG Wealth Advisors and Metcalf Partners Wealth Management are separate entities from LPL Financial. The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly.